Hi, welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. Now, this emergency podcast was recorded at 8:30 a.m. Hong Kong time on March 2nd, 2026, obviously in response to the US strike against Iran. And we're going to discuss a few things where we are in the situation, what's the potential impact on the global economy, as well as, of course, the market implications. Now, clearly, this event is still evolving. Situation continues to be fluid, so we'll keep everyone updated through the week and also the weeks ahead of the latest developments. But here are some of our immediate thoughts. So where we are. Now, first, the US and Israel launched a series of airstrikes on Iran on February 28th. The objective of these strikes is to take out Iranian leadership, nuclear sites, ballistic missile facilities, as well as other military infrastructure. Now, by removing the political leadership, Washington is pursuing regime change in Tehran, although there are still no clear candidates or what's next in terms of taking out the leadership. It was confirmed that Iran's supreme leader, Ayatollah Ali Khamenei, was killed in the strikes along with a number of senior Iranian officials. The Iranian government has formed a transitional council to handle state duties, so there is a transition process from Iran's perspective. Iran has launched a number of retaliatory strikes against neighboring countries with US military installations including the UAE, Kuwait, Jordan, Bahrain, and Qatar, leading to disruptions in air traffic as well as damages to civilian infrastructure. Now, what are the potential impact on the global economy? Now, in recent years, we've stressed that Iran itself does not really move the dial in terms of global energy supply in a meaningful way. It accounts for about 3% of global production, mainly exported to China, and there could be enough spare capacity from the rest of oil-producing countries to cover the shortfall in case Iranian output is constrained. However, it does have military influence over the Strait of Hormuz, through which around 20% of global oil and refined products travel through to importers around the world, especially in Asia. Iran has avoided blocking the straits in recent conflicts for an important reason. Much of its oil exports do also go through this channel. So shutting down this choke point could also cut off an important source of revenue and for the country. It also wants to maintain a cordial relationship with other Gulf nations. However, the Iranian Revolutionary Guard has warned that ships they will not be allowed to pass. It was also reported that insurers have cancelled policies and raised premium for ships in the Gulf, and hence some shipping routes have already been suspended, at least temporarily. The potential impact on global energy prices could depend on the duration of the military conflict and the extent of disruptions in global energy supply. Another risk is whether Iran would target energy production infrastructure in the Gulf region. Now, each military conflict and its impact on energy prices are different. For example, at the onset of the Russia-Ukraine war, Brent crude rose from $98 per barrel to $128 per barrel, a 31% increase in less than a month. For reference, Russia's oil production as a share of global output was around 12% back in 2022. In June 2025, in the build-up of the US bombing of Iranian nuclear sites, Brent crude also rose from $64 per barrel in early June to $79. Now, this quickly did reverse, as Iran was more measured in terms of retaliation and there was no clear threat to the Strait of Hormuz. In terms of immediate market reaction in energy market, Brent crude March contract went up to $78 per barrel. And in the short term, the market could also price in higher risk premium given the uncertainty. This could translate into higher food prices given the strong correlation between food and energy prices, as fossil fuels are used as raw materials for fertilizers as well as directly drive transportation costs. On Sunday, OPEC Plus has pledged to raise output by 200,000 barrels per day. However, investors are arguably less concerned about the overall production, but rather the logistics of oil delivery in case there are blockage in the strait. If this energy supply disruption is sustained for a longer period of time, this will imply a supply shock to global inflation. For developed economy central banks, this is a challenge since it raises fuel prices as well as food prices that cannot be effectively addressed by higher rates. It's also long argued that a drop in disposable income could actually risk weaker consumption, and hence you could run the risk of stagflation. For selected emerging markets, especially those with current account deficits and that are net importers of oil, central banks may have few choices but to raise rates in order to maintain currency stability. Historically, India and Indonesia have been more vulnerable in this environment. In terms of economic growth, Japan, Korea, Taiwan, and India are highly dependent on imported crude oil in general to support economic activities, even though they do not import from Iran. South Korea and Japan have over 6 months of reserve, while Taiwan has 3 to 5 months. While they do not import from Iran, an extended blockage of the Strait of Hormuz could be very disruptive to their energy supply and, as a result, their economic activities. China's oil reserve is around 1 to 2 months, and as being the largest importer of Iranian oil could force them to switch supplier from perhaps Iran to arguably Russia. Finally, what does that mean for markets? Assets that could use to hedge immediately against the latest developments include equities in energy, especially upstream exploration and extraction, and also defense companies. This contrasts with sectors that have high energy intensity, such as transportation, that's also affected by closed airspace, metals and chemical production, and consumer discretionaries that could face more downward pressure. Developed market government bonds, especially short duration variety, and gold are also considered to be traditional safe haven assets. Currencies such as Swiss franc and the Japanese yen may also attract inflows. That said, it is important to realize that these geopolitical events tend to have only a temporary impact on markets. Over the long term, a well-diversified portfolio of stocks, bonds, and alternative assets can still help investors to outperform cash over time. Hence, staying invested remains key given the overwhelming headlines and images that we will face in the coming days and weeks. So thanks for listening. If you find this podcast useful, please share this with your friends and colleagues, and of course, consider subscribing. Any additional questions, please feel free to reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on the investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.